They told you this app democratized investing. No fees, no gatekeepers, just a phone and a dream. But here's the harsh truth. Robinhood didn't make people better investors. It made risk feel harmless, like a game with confetti and no pause button. And by the end of this story, you'll see how a swipe, a notification, and a green button helped trigger one of the most controversial financial blowups of our generation. Picture America in 2020. Lockdowns, stimulus checks, 0% interest rates. Sports were canceled, casinos were closed, and boredom was everywhere. Now drop a sleek app into that moment. Bright colors, clean design, instant trades. Stocks move like slot machines, options look like power-ups, and every win explodes in digital confetti, because apparently nothing says sound financial decision than party poppers. Robinhood didn't feel like Wall Street. It felt like Instagram met Candy Crush, but for money. Millions of first-time investors piled in. Teachers, students, Uber drivers, people who'd never opened a brokerage account suddenly trading volatility at 2 a.m. from their couch. And hey, who could blame them? The app made it feel easy, safe, almost responsible. Because when risk is wrapped in good UX, your brain forgets it's real. And that's where the story quietly starts to get uncomfortable. Officially, this is the story Robinhood tells. Two Stanford grads, Vlad Tenev and Baiju Bhatt, looked at Wall Street and saw a rigged game. High fees, insider access, ordinary people locked out. So in 2013, they built Robinhood with a radical promise: democratize finance for all. No commissions, no minimum balances, no intimidating Bloomberg terminals. Just tap, trade, repeat. And on paper, it worked. Millions of Americans bought their first stock ever on Robinhood. Young investors, lower-income users, people historically ignored by big banks. Even better, Robinhood claimed it wasn't making money off users, but for them. Orders were routed efficiently. Trades were free. Finance finally modernized. But here's where the official story starts to crack. Because if trading was really free, why did Robinhood make billions? If complexity was removed, why were users trading options at record levels? And if the goal was education, why did the app reward frequency, not understanding? Robinhood didn't remove friction, it removed pause. And when you remove pause from risk, you don't get empowerment, you get acceleration. One detail flips the entire narrative on its head. Every extra trade you made quietly boosted Robinhood's profits. Once you see that, the free trading promise starts to look very different. Robinhood's business model wasn't broken, it was perfect. The app didn't make money from commissions, it made money from behavior. Every time you hit buy or sell, your order wasn't just sent to the market, it was sold to high-frequency trading firms who paid Robinhood the right to execute it first. This is called payment for order flow. Legal, common, and wildly misunderstood. The catch, those firms profit when you trade more often, not when you trade better. So Robinhood's incentives drifted quietly out of alignment with its users. The app nudged activity. Instant deposits, frictionless options approval, push notifications begging for attention. Complex financial weapons simplified into something that felt casual. Options trading exploded. Most users didn't fully understand leverage, assignment, or margin, but the interface treated it like a swipe game. And then came June 2020. A 20-year-old student named Alex Kearns opened his phone and saw a negative balance of over $700,000. The number was a temporary display issue, unsettled trades, not real debt. But the app didn't explain that. No warning, no human, no clarity. Alex believed he had ruined his life. He left notes apologizing to his family and took his own life. The platform called it a misunderstanding. Critics called it something else. Design without responsibility. Because when you gamify risk, someone eventually forgets it's a game. And somehow that still wasn't the breaking point. What came next would push Robinhood from a controversial app into the center of a financial firestorm no one could ignore. By late 2020, the pattern was set. Easy access turned into overconfidence. Overconfidence turned into leverage. Leverage turned small bets into ticking bombs. Warning signs were everywhere. Exploding options volume, first-time traders risking rent money, margin calls most users didn't even know they could receive. But the app kept humming. Green arrows, instant fills, dopamine on demand. Then January 2021 hit. A struggling video game retailer, GameStop, became a symbol. Retail traders piled in, fueled by memes, rage, and the belief they were finally beating Wall Street at their own game. The price rocketed, hedge funds bled, and for a moment it felt like a revolution. Then the button disappeared. Robinhood restricted buying, not selling, just buying. The stock collapsed. Users screamed betrayal, market manipulation, rigged system. They picked a side. Behind the scenes, the reality was uglier and less heroic. Robinhood's clearinghouse demanded billions in collateral overnight. The volume, leverage, and volatility had gone nuclear. A system built for speed had no brakes. And when pressure spiked, it cracked. Greed met denial. Denial met math. And math doesn't care about vibes. The moment of impact didn't happen on a trading screen. It happened in Washington. Cameras, sworn testimony, a hoodie under a blazer. Vlad Tenev sat before Congress, calmly explaining why millions of users were suddenly locked out of the trades they wanted most. No conspiracy, no master plan. Just margin requirements, liquidity stress, and a system pushed past its limits. To the public, it sounded absurd, a democratized platform that froze its own users at the worst possible second. To regulators, it sounded familiar, a fast-growing financial product that scaled faster than its risk controls. The confetti was gone, the jokes stopped landing, and the game suddenly looked very, very real.
But the real damage didn't end with GameStop. That was just the moment everyone finally started paying attention. After the headlines faded, the quiet consequences settled in. Millions of retail traders were left holding losses they didn't fully understand how they'd taken. Not from bad luck, but from leverage layered on top of inexperience. Options expired worthless, margin wiped accounts, and many users simply stopped trading altogether. Robinhood paid a price too. A $70 million fine from NPIRA, public apologies, new warnings, slower approvals. The app grew up because it was forced to. But the deeper impact wasn't financial. It was psychological. An entire generation learned about markets through a screen that rewarded speed, not patience, activity, not comprehension, excitement, not risk management. The industry felt it. Payment for order flow came under scrutiny. Fintech design teams started asking uncomfortable questions about nudges, dopamine, and responsibility. Because the lesson was hard to ignore. You can't democratize something by making it feel effortless, especially when the downside is very real and very uneven. The damage wasn't just money lost, it was trust. Robinhood didn't fail because it was evil. It failed because it confused access with understanding. Removing fees didn't remove risk. Removing friction didn't remove consequences. It just made both easier to ignore. For a while, it felt like finance had finally caught up with the internet. Fast, fun, and open to everyone. But markets aren't social media, and they don't forgive design shortcuts. The real lesson isn't don't trade. It's this. When investing feels like a game, the losses stop feeling real until they are. And the next time a shiny app promises to change everything, the most important question isn't what it lets you do, it's what it quietly encourages you to repeat. If you enjoyed this video, hit like and subscribe for more cool stuff they don't teach you at school.